Welcome to Talking Property. Today I'm joined by Australia's best property analyst, Louis Christopher, as we preview the second half of the 2020 property market. Louis, thanks for joining us.
Nice to be here once again, Peter.
Thank you, Louis. Now, very, very dramatic first half of the year. What's your forecast for the second half of 2020 for the Sydney property market, Louis?
Well, Peter, in being upfront with you, we have no outright base case forecast.
Yes.
It's really, really difficult to forecast straight out with the moving target that is coronavirus. Much depends on what coronavirus does, and I'm certainly not a medical health expert. So with that in mind, though, we have considered a number of scenarios that could play out depending on what coronavirus does, and importantly, how our authorities respond to any type of second wave. So going into coronavirus back in April, we had two forecasts that we presented to the market. And one was a very bleak scenario, which would have meant, or was based on, coronavirus staying with us right throughout the course of the year, restrictions staying on the economy right throughout the course of the year. And of course, that hasn't not entirely played out. We've largely defeated coronavirus now, and many of the restrictions have now been lifted, but of course not all of them. There was also a more positive scenario, which was more of a V-shaped recovery.
Louis, what segments of the market will perform best between now and 2021, do you think?
There are two cities when I consider segments of the markets. Geographically, I think there are two cities which are outperforming right now and are likely to continue to outperform, and they are Perth and Canberra. And they are for two reasons, different reasons. So Perth is outperforming because commodity prices such as iron ore, has actually held ground. So the city is actually still getting income coming through. There has been reasonable employment growth. We're still seeing a fall in rental vacancy rates in Perth. And let's just keep in mind that when we look at valuations, Perth is actually offering fair value. And I think Canberra is outperforming because we know there's been a rapid increase in federal government spending. That has, of course, meant there's been more experts coming to town, there's more lobbyists coming into town as well. And so the public service sector in Canberra has probably been increasing. And so that has meant that demand for housing has more than held ground.
Louis, Canberra also scrapped stamp duty and went with a broad-based land tax as an alternative to raising government funds.
Yes.
That's something that's been discussed in New South Wales. Do you see that being introduced anytime soon? There was a period there where the New South Wales Treasurer Dominic Perrottet was very positive on that, and it seems to have gone quiet.
Yes, our New South Wales Treasurer has been pushing it. I think that's clearly something he wants to see happen, but it's not that easy to actually enact and engage. The reality would be that if we were to completely eliminate stamp duty, land tax in terms of payments on a house would probably come in for the average property owner at about $6,000 a year. That's a fair amount of coin to make up. And I'm not so sure whether that's going to be that palatable. I would like to personally see it happen. I think it would help with affordability, and it would certainly help the industry overall.
Would council rates be in that $6,000 a year?
Yep, council rates would be included.
In the media, we hear two phrases that I'm keen to get your thoughts on. The first is a V-shaped recovery, and the second is pent-up demand. Do you believe in the second half of 2020 that we will see pent-up buy demand play out, or is that a misnomer, that concept?
Much is dependent on when the international border opens. So last year, in terms of net migration, we had 240,000 people coming through to Australia. That represents pent-up demand. That's real increases in underlying demand. This year, we'll be lucky to get 30 to 40,000 people come through. So in terms of that growth and underlying demand, it's going to be a very weak year. So I don't really see a lot of pent-up demand there. Now, when it comes to the V-shaped recovery, which was one of our scenarios, the most recent readings on the market would suggest we're not going to complete a full V-shaped recovery. we're not going to get back to the activity levels that we had prior to the crisis. But the activity levels have definitely picked up from the lows we had in April, and will likely pick up provided we do not see a second wave with virus cases, which would then potentially lead to more restrictions added back onto the community.
In recent times, SQM Research, your company, and the 4 retail banks all came out with scenarios, not forecasts, but scenarios,
yes,
where property prices could drop somewhere between 25 and I think the CBA were at 32%.
Yes.
What went into that scenario collectively that we should be all looking out for to see if house prices would react that way?
Yes, so our bleak scenario was a fall of up to 30% in Sydney and Melbourne, less falls in other cities. And that was based on the assumption that restrictions that were which were placed on the community over March and April would stay with us for the course of the year. That has not happened. We have seen a lifting of restrictions. So we believe that scenario, the probabilities of that scenario playing out have lowered. But it hasn't entirely been eliminated, Peter, because we still could get a second wave come through. And then much will depend on terms of how the authorities would respond to a second wave of virus cases.
The Australian government and the Chinese government seem to be getting stuck into each other at the moment, and some are speculating that Australia could enter into a trade war with China.
Yes.
Do you see that as a risk that could impact house prices?
There's no question that a trade war would limit our economic output. It would put a cap on our potential economic output. And that would affect unemployment levels, which would then affect the housing market in terms of how much the housing market would rise or where the housing market indeed is at. The housing market historically has been influenced by the levels of employment. There's definitely been periods where we've had high unemployment, and that has meant lower housing prices in real terms at least. So there could certainly be an influence if we were to have a rather aggressive trade war on the housing market.
Louis, how will the removal of the government's JobKeeper program and the bank's moratorium on mortgages, which are both scheduled to end in September,
yes,
how will that play out as we head in towards Christmas?
If the authorities do a hard exit out where they just suddenly cut off JobKeeper completely and the bank moratorium is completely gone, potentially we could have a hard landing in the housing market. And I'm sure state and federal government are well aware of that risk. My view is that we're likely to see a phase-out period instead, an easing of these grants and these benefits will likely occur. Now, if I'm right about that, that would mean that the housing market should hold. But if we were to see that sort of harder approach upon the economy, then that would be a rather big negative for the housing market.
So I'm getting a sense from you that the trajectory we're on is by no means immune, but it's pretty safe from a crash, and we're doing pretty well with our housing market to keep it on track. Is that a fair summation from where your view is at the moment?
The odds of a crash have definitely lowered. There's no question about that, and we're certainly not having any crash right now. But the odds have not been completely eliminated for the reasons mentioned before. On the flip side, I think it's very unlikely we'll go into a new boom. Yes, we've got very low interest rates and that's been supportive of the market, but we still have restrictions on the economy. And while we continue to have those restrictions, it's unlikely we'll see any type of aggressive rise in dwelling prices.
Home buyers are frustrated by the record low stock levels. Can home buyers expect more stock running into the end of the year?
I think as the lifting of restrictions occur, the market will return back to some type of normalcy, and sellers will recognise that the market is not falling hard, that there is some buoyancy there are buyers there, and they may well enter into the fray. Right now, I think many sellers are looking at the market and judging that it's a weak market and not a great time to sell, so they're holding off. And of course, there's very few forced sellers out there because of the banking moratorium.
Yeah.
So overall, it's a market right now which fewer buyers, fewer sellers. As we see a lifting in restrictions, we should see a more active market, but it's very unlikely we'll get back to the levels we had prior to the crisis, Peter, by simple virtue that we still have some restrictions and unemployment is still relatively high.
And there was a case for saying the market was potentially too strong at the end of that boom rally, wasn't it? Like in Sydney, it felt like property prices between May 2019 and early March 2020, it felt like property prices did 15, 16% in that period.
You're not that far off the mark. The index numbers are suggesting more along the lines of around 12% up from that time. It was definitely a strong market. You may recall we were relatively bullish or positive going into 2020 before this crisis for the market. But of course, coronavirus changed everything.
Yeah, it certainly did. Louis, landlords want to know, when will rents start rising again? They've taken a big whack during COVID. Many of them have had to offer rent reductions to support their tenants, and many landlords have been incredibly gracious in doing so. But they do want to get back to normal operations. What are you seeing there?
I see continued weakness for now, Peter, and it will remain weak until basically we see a lifting in the international border as well as state borders. There is an oversupply at this point in time, and it's hard to see that oversupply being absorbed until we see an increase in underlying demand.
Yeah. So landlords are faced with a scenario, correct me if I'm wrong, where prices will hold, but rents will continue falling. Do you see that as a scenario where you could suddenly see landlords opt just to sell out of their investment and take cash off the table, thus creating extra stock into the market?
Yes, I see that. I think landlords will opt to do that. Property will become too hard for them. Dealing with tenants will become too hard, and has become quite hard for many landlords.
Yeah.
So many will consider that they want to get out for a while and just live life with a little bit less stress.
We're in winter now. Stock is low, as we know. The market's holding surprisingly well. JobKeeper, government support, banking support's due to end in spring, when stock levels traditionally go up anyway. Would you say a new vendor is better off selling now during winter or waiting for the traditional spring season?
Oh, that's a really good question, Peter. Let's consider spring. Back at that time, let's say we see a lifting in restrictions, further lifting in restrictions. Let's say we get back to normalcy, where even the international border is open. We'll see an increase in demand compared to what we have now. So holding off for sellers might actually be a better option, potentially. At the same time, your points raised about how we'll see a moratorium lifted, we'll see JobKeeper being phased out, could be a negative for the market as well. All up, there's a lot of uncertainty for the future. We don't know exactly which way this is going to go. Right now, there are buyers in the market, not as many certainly as what we had at the beginning of this year. If I was a seller, right now, I wouldn't be afraid to sell, put it that way.
Now, overall, stockbrokers will rate a stock as a sell, buy or a hold. So I'm going to put you on the spot here, Louis. There's lots of contradicting and dynamic factors in the market at the moment. Do you call Sydney property at the moment a buy, sell or a hold?
Well, much depends on how long you want to hold for. If you're a long-term property investor, I would hold. If you're trying to time the market, that's nigh on impossible, but there is a lot of uncertainty out there, so potentially you would consider selling. So it really does depend on what is your long-term strategy when it comes to real estate.
Yes, indeed. And if someone buys today, are they at serious risk of a major downturn hitting in 2021? Or do you think the economy and the property market will get its legs again?
I see the economy getting its legs to an extent, but there are still risks that are out there, Peter. It's still possible we could have a downturn in 2021. Much depends on what the economy does. How long will higher unemployment be with us? If we see unemployment levels in 2021 of say 8, 9, 10%, that will not be good for the housing market.
Yeah, we've seen so much stimulus and support and this phrase about let's get to the other side, and we are nearly at the other side without wanting to tempt fate as far as beating the health effects of coronavirus goes. But the damage that's been done to the economy, can that be quickly repaired, or does that play into 2021 is a question that's really worth posing, isn't it?
That's right, and we simply just do not know the answers. You're right, there has been some significant economic damage. I'm personally aware of 4 businesses that haven't made it through. And collectively, those 4 businesses were hiring about 80 staff. Those 80 people no longer have a job.
Yeah, very sad, very painful. Let's hope the bread lands buttered side up, Louis.
That's it.
Yeah. Thanks for your time today. That was great information. It'll help our audience.
Nice to be with you once again, Peter.
Thanks, Louis. And thank you for joining us today on Talking Property. We'll see you next time.